Welcome to the Cash Flow Factor, the podcast where we share practical strategies to help you build stronger, more profitable businesses. I'm your host, Dawn Porthouse. Today we're tackling an invisible threat that could be quietly draining your company's cash flow: tax mistakes. They aren't just minor slip-ups. They're costly errors that can lead to audits, penalties, or even legal trouble. The truth is, if you're a small business owner, you've likely fallen into one of these 6 common traps. By the end of this episode, you'll know exactly how to avoid them and take control of your business finances. So let's dive in and keep your business on the path to success. The first mistake I see far too often is poor record keeping and mixing personal and business finances. This is one of the most common pitfalls for small business owners, yet it can have some of the most damaging consequences. Picture this: crumpled receipts stuffed in drawers, personal credit cards used for business purchases, and no clear system for tracking expenses. Failing to keep accurate and separate records can result in missed deductions, inflated taxable income, and countless hours spent untangling financial transactions. Every expense you fail to document is like throwing money out the window. Money that could have been saved, reinvested in the business, or used to pay down debt. But the problems don't stop there. Mixing personal and business finances can raise a giant red flag for the IRS. It makes your business appear less legitimate and can lead to audits, penalties, and fines. Even worse, it could jeopardize the liability protections that come with incorporating your business. For example, if your business structure is an LLC or corporation, one of its primary benefits is shielding your personal assets from business debts or legal issues. However, failing to clearly separate personal and business finances can pierce the corporate veil, leaving your personal assets vulnerable in case of lawsuits or creditor claims. So how do you fix it? Start by separating your finances. This is a non-negotiable step for every business owner. Open a dedicated business checking account and use it exclusively for business-related transactions, including paying suppliers, receiving customer payments, and covering operational expenses. Having a clear line between your personal and business finances not only simplifies your bookkeeping, but also demonstrates professionalism and financial responsibility. Next, invest in accounting software like QuickBooks, Xero, or Wave to keep your records organized year-round. These tools allow you to track expenses, create invoices, reconcile accounts, and generate reports with ease, saving you time and effort. Most of them even integrate with your business bank account, automatically categorizing transactions, so you don't have to sort through a mountain of receipts come tax season. Don't forget to create a system for managing physical receipts and invoices. Whether it's a filing cabinet or cloud-based document storage solution, keeping your records in one place ensures you can easily access them when needed. Many accounting software options now include features to scan receipts and attach them directly to transactions, making organization even easier. Lastly, set aside time each week to review your finances. Regularly reconciling your accounts and monitoring your cash flow allows you to catch errors, identify trends, and make informed decisions for your business. It's not just about staying compliant, it's about gaining financial clarity so you can run your business smarter, not harder. Another option is to work with a bookkeeper. By taking these steps, you'll not only avoid costly mistakes, but also position your business for success. Proper financial management is the foundation of any thriving business, and it starts with keeping your records clean, accurate, and organized. The second big mistake is misclassifying workers. It may seem like a quick cost-saving move to classify everyone as independent contractors, but the IRS, the U.S. Department of Labor, as well as many states have strict rules about this. The distinction boils down to control. Independent contractors manage how and when they work, while employees follow your rules and schedule. Misclassifying workers can result in hefty back taxes, penalties, and interest, not to mention legal trouble. I've seen businesses face 5-figure bills for what seemed like a small oversight. Take the time to understand the IRS and state guidelines for worker classification and create clear contracts that align with their role. When in doubt, consult a tax or HR professional. A little clarity now can save you from expensive headaches later. Skipping quarterly estimated tax payments is one of the most common mistakes new business owners make. Many are unaware that the U.S. tax system operates on a pay-as-you-go basis. meaning you're expected to pay taxes on your income throughout the year, rather than waiting until tax season. Failing to do so can lead to a double hit, a massive tax bill that's difficult to cover all at once, and additional underpayment penalties from the IRS. It's an unnecessary stress that can be avoided with proper planning. The easiest way to stay ahead of quarterly tax obligations is to estimate your payments based on your previous year's tax liability. If your business revenue is steady or growing, aim to set aside 25 to 35% of your net income for taxes. Create a separate savings account specifically for this purpose to keep the funds organized and untouched. For those who are unsure about how much to set aside or whose income fluctuates significantly throughout the year, working with a tax professional is highly recommended. A professional can help you calculate more accurate estimates. Taking these proactive steps will help you avoid costly penalties and reduce the financial strain when tax season arrives, allowing you to focus on growing your business with peace of mind. One of the easiest ways to overpay on taxes is by overlooking key deductions. The IRS offers countless opportunities to reduce taxable income, but many business owners miss out on deductions like home office, vehicle expenses, or education costs, to name a few. For instance, if you dedicate a specific area of your home exclusively for business purposes, you may be able to deduct the square footage used. Similarly, if you drive for work-related purposes, documenting the exact business mileage is essential to claim those deductions accurately. Always maintain detailed records to ensure compliance and maximize your eligible deductions. Tracking your expenses is crucial when it comes to managing finances, especially if you're looking to maximize tax deductions. There are plenty of apps and software tools available to help you log mileage, store receipts, and organize your expenses efficiently. These tools not only save time, but also ensure you have accurate records when tax season rolls around. Your business structure has a huge impact on your taxes. For example, staying a sole proprietorship too long could mean paying more in self-employment taxes than necessary. Switching to an S corporation at the right time can save you thousands. With an S corporation, you can pay yourself a reasonable wage and take distributions, which aren't subject to self-employment taxes. If your business is consistently profitable, talk to a professional to see if an S corporation is right for you. The tax savings could easily outweigh the additional costs of payroll and bookkeeping. The biggest mistake you can make is trying to handle your taxes on your own. Tax laws are intricate, ever-changing, and can quickly become the minefield without the right expertise. What seems like a small oversight can lead to significant consequences like triggering audits, penalties, or missed deductions that could have saved you thousands. Without proper guidance, you're leaving money on the table, making costly errors, or missing out on opportunities to optimize your financial strategy for both the short and long term. Taxes are not just an isolated component of your business. They directly impact your financial health, cash flow, and growth potential. Relying on outdated strategies or attempting to wing it can keep your business stuck, limiting your ability to reinvest in growth, hire talent, or seize new opportunities. That's why having the right expertise is critical, especially in today's fast-paced competitive environment. Work with a qualified CFO advisor who also understands tax strategy. A CFO advisor with tax expertise goes beyond simply filing returns or insurance compliance. They take a proactive approach, helping you develop strategies that align with your broader financial goals. This multifaceted profession is equipped to handle the complexities of tax planning while enhancing other critical aspects of your business operations. But the benefits don't stop there. They'll also improve your cash flow management, giving you greater control and clarity over your finances. This results in better decision-making, a clearer financial roadmap, and the ability to allocate resources more effectively. Their dual expertise can save you money, protect your business from costly mistakes, and pave the way for sustainable growth. With the right CFO advisor by your side, you'll gain peace of mind knowing your taxes and finances are in expert hands, allowing you to focus on what you do best, growing your business. We've covered a lot today, but here's the bottom line. Taxes don't have to be scary. With the right systems, professionals, and habits in place, you can take control, save money, and protect your business from unnecessary risks. If any of these mistakes sound familiar, don't wait to take action. Thanks for tuning into the Cash Flow Factor. I'm Dawn Porthouse. If you found this episode helpful, please share it with other business owners who could benefit.